Welcome, everyone, to the Directed IRA podcast, a special edition of the podcast because Mark Kohler is in the house at the Directed IRA headquarters here in Phoenix, sitting next to me.
Yeah. So if you're watching this on YouTube, this is a treat. We proved it once and for all. I'm tan and Matt's not.
Yeah, it's not just the lighting.
That's been the age-old excuse. Yeah, well, I got crappy lighting. Nope. Let me just point out, a guy from Idaho is more tan than a guy from Phoenix.
That's because
this doesn't happen.
If you live in Phoenix, you're like a vampire, and like in the summer, you don't go out, you don't see the sun.
True.
No. Now winter rolls around,
you'll be tan,
some tan,
and I'll be holed up in
you're going to be
cabin.
scraping your windshield and putting on your parka. Okay. So,
welcome everybody.
Yeah. Welcome.
Yeah.
Today's, it is a special episode and it's a technical episode.
Yes.
I just want to warn you, this is a little technical, but sometimes we need a little technical in our retirement planning.
Yeah. And for those watching on YouTube, you're going to see we got all these yellow pads here. Matt and I have been kind of fighting over this. Like, no, hold on, what about this example? And, because this is technical and we're really excited about this. So the title of the show is essentially, I screwed up and put too much money in my Roth IRA.
Yeah. And I made too much money and I just did a regular Roth contribution. I didn't do the backdoor Roth like you guys teach, by the way. You high income earners, make sure you're doing the backdoor Roth rather than just dropping money in as a regular Roth contribution.
Yeah. Now, this has happened in two main instances, and we got to step back and create kind of there's some political things going on too now, because this show becomes even more important, not only because October 15th is about 5 weeks away, we're also on the cusp of a bill that could close down the backdoor Roth IRA. So this is a very, very, very important episode, and we're going to try to emphasize that in our posts so that we've got you here. But here's one kind of reason why this happens. And two. Matt just said one. You made too much money and you're like, and we're going to give you the limits. And you may go, I put money in a Roth last year. Did my accountant screw that up? And a lot of times you call your financial advisor and say, I want a Roth IRA, and they just do it.
Yeah.
They don't ask what your income is. So I shouldn't blame the accountant. But then we're going to give you these limits and there's a window. And that's another scary thing, because if you made money in this window and did a Roth, not all of that Roth was allowed. So you have to do math. Oof.
I know. Sorry. Today's math class. I know that was the one you like to skip, many of you. But this is one, in order to get this, it's going to take some math. We're going to try and keep it light as we do.
Yeah.
But there will be some equations here. Now, for those of you that kind of sit in this, maybe you're making between 100 and 200 grand.
Single.
Yeah. You're single or married. I'm just saying in general, if you're kind of making between 100 and 200 grand, you're going to be in the mix here on this. Is like, well, can I contribute to a Roth? Can I not? How much can I put in? Am I phasing out? If I put 6 in, is 3,000 okay? But the other 3,000 was bad. We're going to break that down a little bit. Now, if you're making over 200 grand a year, married or single, I think it's 206.
Yeah, 208 for last year.
208 for 2020. You can't put money in a Roth directly. You've got to do the backdoor Roth.
Now, let me give an example of how this topic came up too. Because Matt and I know this topic's out there, but I had a client, great client, he may be listening, I'm not even going to say his first name. He called me up and said, Mark, in fact, we're working on a charitable remainder trust right now. He knows who he is, he and his wife. And they go, we contributed to a Roth last year. And I go, you made 600 grand last year? He goes, what? I can't do that? Oh, okay. So you've got what's called an overcontribution problem. He's like, what the hell's that? So Matt just made a good point. Any of you that make more than 200 grand a year, married or single, that's a good cutoff to just say, no, I'm going to actually say it this way, because if you're single and made more than 150 grand last year, just to keep it simple, and if you're married and made more than 200 grand last year, and you contributed to a Roth last year, red alert.
Red alert. Yeah.
Now, if you're between 100 and 150 single, or maybe 190 and 210 married, get your pencil out to do some math. So, but hopefully we've kind of thrown a net out there. So all of you listening, you're like, oh, that's me. I could be in that boat. And
yeah. So what you have to do is you have to figure out how much did I over contribute? Right. So if I threw in 6.
Well, we're going to go through the steps here.
I know. I'm just going to say in general.
Oh, in general.
That's why these numbers matter.
Yeah.
Where you are in the scale matters, because there's a calculation of, well, how much of what I put in was an over contribution.
Yeah. And we're going to go through it.
And again, if you're under those numbers, then you don't worry about this. You're within the guidelines. You've played by the rules. You get to go in the front door of the Roth IRA party.
So if you're listening, this is not one for the commute. Seriously, make a note to listen to this when you get home.
There might be some people smart enough for that. I think we got some listeners smart enough for that.
You're going to be taking notes. I feel it already. So we do not want to contribute to your texting and driving or note taking and driving problems. So watch this at home or listen to this at home. Maybe you'll enjoy doing it on YouTube, which you can always get to us. I'll throw this out as well. If you enjoy the show and you're like, oh my gosh, these guys are like totally helping build my retirement, please give us a 5-star. We would really love that review. And also on YouTube, you're going to be able to catch this show on the Mark Kohler channel every week. And please share it, hit the bell icon because we go live. In fact, in another hour, we're going live in a minute on this new House bill, which brings us to the House bill. Matt, why does this topic matter in context with the political climate? I mean,
the backdoor Roth IRA was the way you get money in if you make too much money. And it's a fix sometimes for people that have done this over or excess contribution. So, but that may be closed out. We'll see how this tax bill shakes out. We're talking about it here. And by the way, if you're listening to this, we've already talked about it. Yeah. So go catch the recording though. It'll be on Mark's YouTube channel. Now this podcast episode, or if you're watching on YouTube, is usually on my channel, actually, I think.
Yeah. But both, yeah. And it's on both. Okay. Yeah. I can tell I just offended my amazing partner. He's like, I got a channel too.
I just want to let people know where they're at.
We both have YouTube channels.
Yeah.
Okay.
But there's a lot of other things in that bill. But just for you people trying to get money in a Roth, even the ability to convert could be restricted for high income earners. If you're making over that 400, 450, they're going to close out your ability to convert over to Roth.
Yeah. And oh my gosh, there's so much here, Matt, we got to talk about because, all right, we'll focus on the topic at hand of doing too much of a Roth last year in 2020. But I'm just going to say this again. Why it relates to today is that as you're fixing your 2020 problem, you're looking down the barrel at an increase in tax rates in the highest bracket from 36 to 39.6. And I had a client the other day that said, I'm just going to rip the Band-Aid off and convert $1 million to Roth right now in my traditional because it's sitting in crypto and I know it's going to blow up. I'm just going to convert it right now because if I convert it next year, it would be an additional $40,000 in tax approximately. That's not even counting state. But then, as Matt said, based on their AGI, they may not even be able to convert next year. So this is a wake-up call to say, not only am I going to fix what I did last year, maybe I need to reevaluate my entire Roth traditional portfolio and look at the increased tax rates, the backdoor closure.
Yeah.
That backdoor is going to be bolted.
Yeah, it might be. It's going to. Well, here's the funny thing. The backdoor might work for you if you're between 200 and 400 because the backdoor is only closing if you're making over 400 grand under the rules. It's not totally closed out. So now we're getting like this backdoor that's like, you have to have a special pass to get in now.
You know what I'm thinking of? I'm just envisioning right now 16 candles and Michael Anthony Hall trying to get into the party, right? Remember that? He had his 2 friends with him and he's trying to get knock. I want to get in, Yeah. And then at the end of the party, he's underneath the coffee table under the glass and he's like, Jake, let me out, Jake. That's the party I'm thinking of. Okay.
Yeah. Not that.
You don't remember that part?
I don't remember that part.
It's an 80s. Yeah, it's an 80s thing. Okay. All right, Matt. Let's focus on
our calculators out and pencils.
Yeah. I want to say one more thing though. We have published both blog articles on our, we have both published articles on our blogs. We've shot videos on this and we've got links to all of the legislators and senators and representatives are both legislators. So whoever in Washington is representing you, we've got a link for you. But please get over there. If you're listening to this podcast or watching this on YouTube, you want to protect your Roth IRA or your traditional IRA and be able to self-direct. Get to those articles, send a message to your representative. You want to can you urge them any more than me?
I thought that was great. I was just going to say amen. Like now's the time. You just got to make some noise. And let them know how important it is for you to have investment choices and not be forced to just buy more stuff on Wall Street. So that's what's at stake.
Okay. Now, on this topic of screwed up, Matt, I'm going to ask you number 1. Okay. I put these into steps. So, Matt, step 1 is if you're watching or listening, you're like, I don't even know if I screwed up last year. So that's step one. Step one is calculate the overcontribution. Maybe I didn't do anything wrong.
Yeah.
Maybe I'm okay. So tell us how we do the easy way before we get into this mess. I look over on your.
Okay. All right. Well, let me say we got to talk about the first number you need to know. You need to know.
I hate this number.
You need to know it's magic. It's your modified. It's what? Ooh, it's magic. And when I'm with you.
I've never thought of that song when I think of modified adjusted gross income.
Well,
but now
modified adjusted gross income calculation.
Ooh.
There you go. All right.
Okay. It's magic. I think I hit the note a little better than you.
You know, my band Spilby Dog used to play that song. So
see, he had a band and I hit the note.
Yeah.
I'm just saying.
I played guitar. They wouldn't even let me sing backup vocals. They're like, and then they let me just have like a microphone to look cool, but they like turned the volume down so it didn't pick up anything.
Okay, now some of you are like, am I listening to the right podcast? Yes. Matt Sorensen is a rock star. If you've got a tax attorney that's in a band, you're in the right spot. Yeah. Okay, so Maggie, you got to figure out your Maggie. I like that. Number one, I'm changing my list already.
Now
Number
here's how you figure it out.
Okay.
Okay, it's a 2-step. Okay. Step one. You figure out your adjusted gross income.
There's some pins and needles there.
I wasn't going to say it.
Okay.
You figure out your adjusted gross income. This is line 11 on your 2020 1040. Adjusted gross income.
Right.
And that's just step one.
Okay.
So your Roth contribution is not your adjusted gross income. It's your modified adjusted.
Okay.
And the next step is you take that number and you subtract out some things.
I thought it was add back.
Oh, yes. Sorry. You're right. Add back.
Okay. Add back. So we got this list of crap we're going to add to it. So if you thought you only made so much, now we get to add back to it and you actually made more in the eyes of the IRS.
Yeah.
Okay. Add back. What is this list?
Okay. We're going to add back in student loan interest.
Okay. Now hold it. By the way, there's a link in the post to the podcast and the video to my article that has this list. So don't freak out. Just sit back and listen. Just relax. Okay. Matt's going to read you it's like a bedtime story.
I'll just give you a few. There's a number in here, but I'll just give you the common ones you need to add back in. Student loan interest, 1/2 of self-employment tax, because you get to deduct half of that. You got to add that back in.
That's only if you're a Schedule C. If you're an S Corp, don't worry about it.
Yeah.
Okay.
Your IRA contributions, but you're probably not doing that anyways because you're fixing this already. And then rental losses. If you took rental losses, you got to add those back in too.
Ooh, wow.
So.
And there's adoption expenses, Social Security payments. There's some savings bonds. Who has savings bonds? That's a dumb list.
Know. I'm just saying that's the complete list from the IRS.
This is a 1932 list.
Yeah. Who has savings bonds?
All right. Okay. So you add back, and after you add back any of these things, you have magic.
Magic. Now, if you're magic, your modified adjusted gross income.
Okay. Step one.
Should we go talk to the single ladies and the single
ladies?
Oh, the single ladies.
Okay. Here's what I think. And you actually suggested this before the show. Keep it simple. Let's not do this phase thing yet.
Yeah.
Say, did I do an overcalculation, an overcontribution? That's your next thing. So you have your Maggie, and you have to say, where does the Maggie fall? Where's the cutoff when it's just a clear cut overcontribution?
Okay. For you single folks, 139,000. If you made more than 139,000, and this is for 2022, and you're single.
Oh, it's 2022. 2020.
2020. Oh, gosh, what did I say? 2022.
I got 140. Is it 139?
I think you got the 2021. No, you got 20.
I don't know. Let's keep going. Keep going. Right. I'm going to double check.
139,000 for 2020. If you made more than that, your whole contribution you put into your Roth is an excess contribution, aka overcontribution.
Actually, I'm going to say, hope that's the case, because the calculation, if you're in the middle, sucks.
Yeah, it's actually easier this way to just be the whole thing was excess. Okay. Now, for those of you married and filing joint, you get a higher modified adjusted gross income here, 206. If you made more than 206, the whole contribution that you put in, whether it was 1,000 or 6,000, the whole thing is considered an excess or over contribution.
Okay. All right. I'm just going to confirm this before we go any further, because I want to make sure.
Okay. Now, while Mark's looking at that, let me tell you the under. We just did the over. Let's do the under. All right.
I feel like
What's the over under on the Roth contribution amounts?
If I'm asking that, my wife's like, have you been gambling? Okay. All right.
All right. The under. Okay. For single, if you were under 124, don't worry. The front door to the whole thing on your Roth contribution was open. You got a regular Roth contribution. Don't worry about this. Married, 196. 196 married, filing joint. If you were under 196, your whole 6,000 in to the Roth is considered.
Okay, I'm right here on now. The IRS website's moving slow. This is a financial services firm for 2020.
Yeah, that's.
I'm looking at 124.
That's what I said.
Well, if you're under 124 or over 139.
Yeah.
So 140. I'm actually off 1,000 here and right there, right?
Yeah. All right.
Okay.
Don't worry about that.
Okay. Well, I'm looking.
I got it on the podcast.
Yeah. Okay. Yeah. Look that up. So 124 to 140.
Okay. Now, for everyone in the middle there, for example, you single people between 124 and 139 or married.
No, 140. So
sorry, it's 139.
124 to 140,000.
139.
139. Damn it, you're right. Okay, so 124 to 139.
And he's the CPA between us.
Well, I'm just upset that my calendar's wrong on this little number.
You're honest there about that.
Okay, all right. Okay. Keep going.
Married, filing joint between 196 and 206. Okay, if you're in here between these brackets, we got to figure out how much of what you contributed is excess.
Oh. Do I figure it out?
What?
I was looking at 20. My calendar is proper for 2021.
Okay. Well, let's do 2021 calendar. So
yeah, but we're fixing our 2020 contribution.
Yeah,
so
these numbers we're giving is the 2020 because many of you may have to be doing this right now in the next few weeks. So we're giving the 2020 numbers. And it goes up as we're seeing here, maybe 1,000 or so on these numbers each year.
Okay. Now, if this has been Garbled Group, let's everybody together take a breath. You didn't take a breath.
It was like a
slight breath.
It was a sigh.
Okay. Mark Kohler here. You know what's fun about this podcast is we're debating for you, people. We're trying to get the right answer for you. So I'm going to restate what we have determined to be the case. If you're single and in 2020, you made a contribution to a Roth when you made more than $139,000, anything you put in that Roth IRA is jacked up. That is your overcontribution. If you made with your MAGI, your modified adjusted gross income, somewhere between 124 and 139.
What? That's single. Sorry.
Single.
For married, 196 and 206.
Yeah, I'm doing single first. So it's 124 to 139 single. And then for those that are married, it would be the 196 to 206. If you're in those windows, you got to do an extra calculation to figure out how much you over contributed because you're in this window where it started to phase out. Okay, so that's, I think, so we don't get too muddy. That is step 2. You figured out your MAGI.
That's what I just said.
It was getting a little hectic in here.
Right.
Okay. All right. This is why we're a good team. Okay. It was getting a little hectic. So step 2 is figuring out that overcontribution amount. Now, once you figure that out, write it down up in the right-hand corner of your pad because we got to figure out another number now.
Well, we got to figure it out. We're going to tell them how to figure out the overcontribution?
Well, anything over 139 if you're single or 206 if you're married. All of it's bad.
The whole thing's bad.
Yeah. In the middle, there's a table. Do we want to go through it right now or just say go to the article?
Let me just say how the table works.
Okay.
If you're single, let's start at 124. Okay, that's when we start having this quote unquote phase out. Under 124, the whole thing's cool. Don't worry.
Okay.
But you're between 124 and 139 somewhere. So you got to figure out how much of what you put in is in excess. Every $1,500 you go up from, let's say, 124 to 125.5, you have to reduce how much you put in. You can't put in 6, you can only put in 5,400. And then every 1,500 you go up, you have to take out
60% of it.
Yeah, you have to take out basically $600.
Mm-hmm.
Now, for married, every 1,000 you go up, so 196 to 197, same thing, reduces down $600. So from 6,000 to 5,400. So for example, if you had 200,000 married, filing joint, you can only put in $3,600. So if you put in a full 6,000, you would have over contributed 2,400.
Okay.
All right.
Perfect. I love it. So
now there's some tables on this you can find and
no, in the article below, there's a table.
There you go.
You just go there.
All right.
And once you find out your over contribution, this adjusted number, if it's in the table or if it's above it, the whole thing.
Yeah.
And like Matt said at the beginning, if you've made a Roth contribution and your income is, you're a modified adjusted gross income people, your Maggie has to be below these numbers, the 124 or 196. Then you're okay. Okay, so that's step 2. Now, step 3. Spoiler alert. When you go to fix this, fixing the overcontribution is one thing. Fixing how much money you made on that overcontribution is another thing.
Yeah.
So step 3 is we got to figure out how much money did you make on that overcontribution during that period. Back to the math. Do you want to try or can I?
Yeah.
I like your example.
Let me say
your example.
Yeah, I'll do my example.
Okay.
Let me say option 1 though. Option 1 is just, just kick the whole thing back out. I did it wrong. I put in 6 I shouldn't have. I'm just send it back to me.
You're wrong. Because if you made money on that 6, the money you made is 10% penalty and tax.
I know, but I'm just saying that's still your option. I'm not saying it's the one you take, but we've had people do that.
Before you go to step 3, you want to just say, take it out.
Well, I'm just...
Okay, you're getting ahead of yourself.
Well,
okay.
Sometimes I like to go in order. I want to give you the bad options first so we can get to the reveal. This is the build up to the reveal. There's a solution.
Yeah. The reveal Matt's at is you're going to ask the IRA company to send you some money. And you're going to want them to send you your overcontribution and the gains on your overcontribution. Whether it's in 199 or 2 1099s, different topic. But the point is, you're going to ask to get the money out, or you're going to continue to get penalized every year in perpetuity for what you did wrong, which sucks. It is not good. So we're going to come to that. But first, we need to figure out, did you make money on the overcontribution? Now, before you give your example, let me say this.
All right.
Okay. Right now, we are sitting at September, what is today? 21st, 23rd? 23rd. So it's September 23rd. You listen to our podcast and you go, oh my gosh, thank you guys. You're right. I overcontributed. And you figure out how much you overcontributed. You want to immediately look at what is the balance of your Roth IRA that you contributed to today. And then we're going to try to figure out how much money did you make on that Roth contribution since the date you made your contribution last year. That time period that you made money on the overcontribution is important because we got to figure out the adjusted opening balance and the adjusted closing balance of your Roth IRA as of the day you determined you made a mistake. And you're going to calculate the earnings on the overcontribution. Matt's going to run you through an example of what that might look like. But those earnings, there's no way out of it. You're going to pay a 10% penalty and tax on that because you made money when you shouldn't have. So the IRS is there's no way out of that penalty. We cannot save you on that. So Matt, give us a really good example of what that might look like.
Okay, let's say this is your facts here, and we made them easy so we can do the math here. You'll see.
Yes,
but it's
you guys are brainiacs.
It's the same theory. All right, let's say you had a Roth IRA with $8,000 in it
last year,
and you put in $2,000 as a new Roth IRA contribution, so you got up to 10. Now, 9 months later,
now that's the adjusted opening balance.
Yeah, 10K.
Now, and I put in, now how much of that was valid?
Let's get to what the account's at now. Now the account's at 15K.
Okay. Adjusted closing balance, ACB.
Yep.
Okay.
All right. Now, when I put in that extra 2, let's say 1,000 of that was an excess contribution. So 9,000 is good. I have an extra 1,000 in there I shouldn't have had. I overcontributed. I have an excess contribution of 10%, 1/10 of that 10,000.
Now, I like where Matt saw it. Before we worry about what it's worth today and what the earnings are that you made, we've got to figure out that opening balance, which was 8, plus, now we're adjusting it. That's why you call it adjusted opening balance. We're going to say adjusted opening balance is 8 plus the 2. And then Matt says 1,000 of it's bad. So you're going to take the 1,000 divided by the adjusted opening balance, which is 10. That means 10% of your opening balance was tainted. That was an overcontribution amount.
Tainted love. That's all I
Tainted Love. Boy, we got magic, Tainted Love. This is the music show.
80s.
No,
good 80s.
yeah, no movie quotes. It's all music. Okay, so you're going to remember that 10%. Remember, 10% of your Roth is now tainted.
Mm-hmm.
Now, we were doing other math examples that were 0.3 and 0.6 and 0.066.
And Mark wasn't carrying the extra 66666. So the numbers were a couple bucks off. And he was like, this isn't right. And I'm like,
oh my gosh. Yeah, it was not good. Okay, so now we have our adjusted opening balance and our tainted percentage of that Roth. Now let's go to the closing balance.
All right. Now we had a closing balance of 15 grand. So we had 5,000 of gains.
Woo!
All right.
Okay, so I made 15,000. Sorry, I took 15,000 minus the 10. I have 5,000 in profit.
Yeah.
Pretty darn good.
Yeah, that's your gains.
Now, don't look at what was my profit last year. Don't look at your statement on your Roth. We don't care.
For this, it doesn't matter. I know it matters for you and your retirement account growing, but I mean,
that's right.
You know what I mean?
You're going to look at the exact date of what the balance of your Roth was when you made the contribution last year to the exact date of today when you discovered the mistake. Now, if you fix this before October 15th, you're going to really want to do that. That's why we're doing this show. So hopefully you're figuring this out between now and October 15th. I've got my 5,000 in profit. Okay, what do I do next?
All right. Now we've got that 10%. And if you think about it, 1,000 of the full 10,000 is the tainted. So 10% of the earnings here, the gain, is also tainted. $500.
That sounds good. I'll have that.
Yeah.
So 10% times 5,000. Even a fifth grader could do that. We are at $500 of illegitimate profit.
Yeah. So you have an excess contribution of 1,000 plus 500 of excess earnings.
Okay. All right. We got our two numbers. So now we can go on to step 4. Now, up in the corner of your yellow pad, you've got your Maggie, your modified adjusted gross income. You've also, number 2, you've figured out my overcontribution amount. And number 3, you figured out my percentage or tainted percentage of my Roth. And then number 4, you figured out my profit that's bad. So I got these little numbers you're keeping up in the corner. So I've got bad profit of 500 and an overcontribution of 1,000. Now on our yellow pages, that sounded good, like paper chase.
Yeah.
Okay. What to do now? Okay. Do you want the easy one? This is where you wanted to go earlier.
Oh, yeah. What to do now is you just take it out and say, I shouldn't have done it. I didn't qualify. I just want to get it out.
What do you want to get out?
You want to get out the extra 1,000 you shouldn't have put in.
Okay.
Plus the 500 excess. Now the extra 1,000 is just going to get kicked back to you.
Yeah.
The 500, you're going to have tax and penalty on.
Now this is option 1, and this is before April 15th, or with extension up until October 15th. Now we'll come back. If you've already filed, we'll talk about that in a minute. But option 1 is I'm just going to take a 1099. I'm going to call it my IRA company. We do these here at Directed IRA all the time. And you're going to say, I need $1,500. And this is before you filed your tax return with extension before October 15th. Now I'm going to say a practical note. I would talk to your accountant and say, yo, I'm dropping off my crap to do my taxes in the next 5 weeks. And they probably hate you already because the deadline's 5 weeks away.
It's really like 3 or 4 weeks.
Oh, it's only 3 weeks away. That's right. Gosh, October 15th. So it's only 3 weeks away. You're going to say, I'm going to bring you a 1099 or fax it, or no one faxes. Sorry. You're going to scan it and email it over to your accountant and go, I'm going to send you a 1099 for $1,500. 1,000 of that was a non-deductible overcontribution to my Roth. 500 of that is subject to the 10% penalty and taxes. And your accountant will hopefully go, no problem. I'll make sure you're not taxed on the 1,000 because you're just taking out your overcontribution.
Yeah. Now, here's the problem. When you're fixing it now for 2020, you're actually not getting a 1099. Your IRA company is not going to send you a 1099 until next year. So if you did this last year when you're like, oh, I put money in and I want to get it, you would have had a 1099 on this. So you're going to be reporting this on your return actually without the 1099 when you're doing it now.
Yes.
Up and trying to hit the tax deadline for last year. Because anyone else, we issue 1099s once a year based on the last year's history.
Oh my gosh. Now, as an aside, you're going to file a form 5329 with the IRS because they're going to want to know the story. Yep. That's where you kind of explain all this math.
Yep.
Is you're going to say, here's the overcontribution, here's the penalty, and you're right. No one's going to send you a 1099. Oh, so you're going to go meet with your accountant or get over the phone and email this in and yada, yada. Now, option 2, I don't want the IRA company to send me the 1,000.
Yeah.
I can what?
Option 2 is, let's say 2020, when you put that $2,000 in, was just a good year. You usually don't have that type of income year. In 2021, you've been down or you're more normal. And so you're like, oh, Matt, I'm married and we made 150 grand this year. Cool. You're going to be fine. Let's just book it as a 2021 contribution. So the IRS lets you shift that to the next year. Now, assuming you're going to qualify that year. So like if you're like, well, I'm making the same money or I made more next year, this one doesn't work. But one option is shifting the contribution to the next year.
So roll it to a Roth IRA contribution. Not roll. That's a scary word. You're going to
change the contribution year. You're going to change the contribution.
Change the contribution. So you'd call your custodian and go, I did an over contribution. Don't send me the 1,000. Send me the 500 because I got to pay tax and penalty on that. But I want you to just take that 1,000 and put it in as part of my Roth contribution this year. And they'll go, did you make too much money? You can really do that. And you go, nope, I didn't make too much money. I can do that.
Yeah. So far. So far. Because you don't know, you're not at the end of the year yet, but you only be doing this if you feel like you're going to be under.
Yeah.
If it's close call, don't do this option.
Yeah. Now, if you go, I made too much money this year. I can't just roll it into a Roth. I overcontributed last year. I don't want to do that again. It's close. I'm just going to do the backdoor Roth IRA that Mark and Matt have talked about. And you don't want them to send you the 1,000. What do you tell them to do? Say, convert it to a traditional.
You're going to recharacterize first.
Okay.
So you're going to recharacterize the contribution as traditional. Right now, whether it's deductible, traditional or not, is something your custodian can't tell you, and they don't track anyways. You do that on your own tax return. So you're going to just have it recharacterized as a traditional contribution.
This is awesome. This is probably one of the most technical podcasts we've done in a long time. Some of you are like, what the hell? I'm not getting.
For the only other person that's still listening, is anyone there? Is anyone out there?
Oh my gosh. Now let me we do have a lot of accountants that listen to us. Now take a breath, everybody. Okay. You've got to fix the screw up from last year. Like Matt said about 15 minutes ago, and I berated him. He said, just send me a check. That is the easiest way. But if you want to if you're an engineer type out there and you're like getting involved with this, your accountant, they could say, well, don't send me the 1,000. Just put it into a traditional and I'll convert it to a Roth later or in between now and the end of the year, or roll it into my Roth this year because I didn't make that much money. So there's we're just trying to throw out, there's some options. But remember, the $500 that you made, you got to still take that as income. You got to take it with a 10% penalty. So the $500 times 10% would be a $50 penalty. And then you'd pop that $500 in as taxable income. What I would say to all of you is if you think you screwed up last year, have these numbers and get on the phone with your accountant. And if you know more about this issue than your accountant, you might have the wrong accountant, or they're going to have to involve a partner or a manager because this is fairly technical. My frontline accountants aren't going to know this. They really aren't.
This is even at directed IRA. I mean, this requires special handling.
Yeah.
Unfortunately, and that's why if you're going to be close on this, just do the back door. If you have other traditional dollars that you don't want to convert, so you're not doing the back door, and you're going to be in these close on this stuff, you're just kind of it just gets sticky.
Yeah. So. Now here's the problem. If you say, you know what, screw it, guys, I'm just going to leave it in there. No one's going to find out. Well, if they do find out, it's a 6%. Don't do that. Don't do it.
Don't even give them the idea.
Yeah, I know. Well, what I'm
telling like the kid, like you can grab this fire, put on a stick, but don't do it. But you could do this.
Yeah, you can flip.
And it's really fun.
Yeah, it's a starburst on a stick with on fire, and then you flip it around and it hits some kid in the forehead. We've all done that at camp. All right. Now, if you leave it there and don't fix this, the penalty is 6% on the overcontribution every year until you fix it. And whatever money you made on that, they're going to force you to take it out with a 10% penalty and taxes. So there's no win. Yeah. There's no good ending to this if you just leave it in there. The sooner you rip off the Band-Aid, the better. Now, for those of you that are listening to this and you're like, I already filed for last year. Well, you got 3 weeks to do what's called an amended tax return. It's a 1040X, and you're going to include Form 5329, and you're going to lay this out. Now, actually, in some ways, doing an amended return with this problem is a little easier because your accountant's got the returns all done. We know what your Maggie is. We know that you overcontributed. So on a 1040X, we're just going to claim the income.
Yeah.
We're going to fill out Form 5329, and we're going to say you made an overcontribution, and we just took it out. And that's it. You don't have to explain that you rolled it over to an IRA this year or you rolled it to a Roth this year. That's Chapter 2 in the book. IRS doesn't care about that. So I think an amended return shouldn't cost you more than $500 to $1,000 at most, because really you're just putting a couple lines together on an amended return. Mm-hmm. That's if you catch it before October 15th. If you do not, after October 15th, the 6% penalty, dang it. You got to pay the 6% penalty for last year's, in this example, $1,000 overcontribution. And you say, well, Mark, I fixed it on October 16th. What's so magical about October 15th? I don't know. What's so magical about October 31st and Halloween? It's either pre-Halloween or it's after Halloween. This is the way it is. There's a deadline. This is how deadlines work. So if you fix this after October 15th, you're already going to pay the 6% penalty for last year.
Yeah, it's like I'm trying to explain to my 15-year-old daughter why she has to turn her assignments in on time. Because they don't get graded or counted if you don't. That's called the penalty.
Yeah, there's a deadline.
The IRS does the same. Can you blame them?
Yeah.
Nobody's getting anything into them if there wasn't penalties.
Yeah. You know what's funny is, though, it kind of climaxed with a lot of technical points, but that's it. I mean, there's really not much more to say.
Yeah, you can recharacterize to traditional and then convert back over to Roth. You know, you will have tax to do that on the full amount.
Yeah.
So,
can I make one moral of the story point? Let's say you missed this and you're listening to this podcast after October 15th, but it's before the end of this year, December 31st, 2021. So you're still kind of in this year of 2021. If you're catching this and doing it, do not delay, because what did you want when this whole thing started? You wanted a Roth IRA. Let's keep our eye on the ball. That's what you really, really wanted. Well, between now and December 31st, we've got options to get you there. Yeah, we got to fix this 6% thing or the 10% thing, and there's some math involved. But the reality is, between now and December 31st, you're probably going to end up with a Roth. And this year's Roth plus last year's can recharacterize. I mean, there's some good news at the end of the day. You're going to have Roth money.
Yeah.
But if Congress passes this bill and you make too much money and we go to fix this, we're talking SOL and not statute of limitations, baby. You are beep, 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 out of luck.
Sorry.
Okay. Wouldn't you agree? I mean,
yeah. I mean, this is one of those things I think some people have ignored. Like, really, do I really need to go fix this? Yes. Trust me, it's in the back of your brain. It's kind of, you don't think it's causing you stress, but it is kind of like bugs you every once in a while. Just fix it, clean it up. Moving forward, you don't have to stress about it.
Yeah. And there's a lot of crappy articles out there on this that make it really technical to understand. But this chicken scratch on my yellow pad and Matt's little, I'm stealing that.
Yeah.
I'm stealing that. And I'm going to finish this article. I have been getting a couple feisty emails from some of you that are like, where's your article? You've been promising it. This isn't easy. And I'm busy. I'm trying to save Roth IRAs for you in Congress. So just chill out. I'm doing the best I can. But I will get this article done. And by the time this podcast goes live. So any final words of wisdom for our listeners, Matt?
no, thanks for tuning in. The few of you that are still left that made it through that math. Having a Roth IRA and contributing to it and figuring it out does take a little bit of work, particularly for those of you that make more money. Congratulations. You have you make enough money, the IRS is going to make it complicated for you. But there's strategies. And remember, I just want to say as my last parting words is the backdoor Roth IRA is still good right now. Follow the House bill. It might be getting closed out for those that make over 400. But it's still around right now for 2021.
Yes.
So you can still use it for this year. That's the easy way to just sidestep this entirely. We got other podcast episodes on how the heck to do the backdoor Roth IRA. Check those out.
This is going to be the year of Roth conversions.
It is. I'm already getting emails quite crazy. Should I convert now? I'm going to be over the 400. Do I need to do it now?
If you're over the 400, not only won't you be able to, not only will you not be able to do it,
you have a higher rate.
You have a higher rate next year too.
Yeah.
And states are trying to catch up. This COVID thing kicked states' butts. So we're seeing tax rates almost every year in California increase and other states. So it's just ugly. So, all right, everybody, thank you for watching or listening. We love you. We're grateful that you are contributing to your IRAs and building wealth in your retirement account. We are as well. Hang in there. Don't give up on the American dream. See you next week.